appreciate that drawings can take or can come in the form of the owner taking goods. So out of the stock of the business, the owner can take some of the goods for his or her private use. It can also be in the form of cash, either from the bank account or from the business safe. So look at this one too. And then finally, when the owner or the proprietor adds his or her private expenses to the firm's expenses. So these are the three forms of drawings we'll look at. So let's pick the first one. Goods taken for owner's private use. Now, anytime the owner takes stock or goods for his or her private use, these are the accounting treatment. So in the trading account, you will deduct it from purchases, and note that you are going to deduct the quantum of goods or the amount of goods the owner took for private use from the purchases. So under your cost of sales, when you begin opening stock, add purchases. As you are adjusting for carriage inwards and return outwards, you also adjust for the goods withdrawn by the owner. So you subtract it or you deduct it. So it means that to be able to determine your net purchases in the trading account, you have to consider or factor any goods withdrawn by the owner. In the balance sheet, it will be treated as drawings, and you know what we do with drawings in the balance sheet. We deduct it from capital or we less from capital under the finance by section of the balance sheet. So that is when the owner takes, very simple, right? The next one is when the owner takes cash or withdraws cash for his or her private use. So for example, the business has 100 million Ghana cedis in the account. The owner goes into the account and withdraws cash of, say, 500,000 Ghana cedis for his or her private use. So what is going to happen, even before we go into the adjustment, is that the business cash is going to decrease because the owner has taken something out. In that case, you would have to deduct it from the cash balance. Okay, so if it is from the bank, you deduct it from the bank in the balance sheet. And you know that cash and bank are current assets. So under your current assets, any cash or bank balance there, you subtract or you deduct the amount the owner took for his or her private use. And then again, it is treated as expenses that is subtracted from capital under the finance by. The next one is when the owner adds his or her private expenses to that of the business. You know, one of the principles or the concept in accounting suggests that the owner should be treated as a separate entity from the business. In other words, the owner is not supposed to add his or her private expenses to that of the business. So the owner cannot add the rent of his private residence to the rent of the business premises. That will be considered as drawings. So in the profit and loss account, that expense which the owner has added, you go there to deduct or subtract. So if it was rent that he added on to the business rent, you subtract it from the rent in the profit and loss account. If it is insurance, you subtract it from insurance in the profit and loss account. Then in the balance sheet, it is again treated as drawings, which is deducted from capital under the financed by section. So you can appreciate that for all the three forms of drawings, it is the same when it comes to deducting it from the capital in the balance sheet under the finance by section. The others depends whether the owner took goods. If the owner took goods, then we are going to subtract it or less it from the purchases. If the owner took cash, we are going to subtract from cash. If the money was in the bank account, we subtract it from bank. Then if he or she has any expense, we'll subtract from the expense. Okay. Now let's look at provision for depreciation. Now this concept is very broad, but under the final account, we try to summarize it and only tell you how to deal with provision for depreciation in the final account. So what is depreciation? Depreciation is simply the loss in value of a fixed tangible asset, and you need to note this. It's the fall in value or the loss in value of a fixed tangible asset due to wear and tear, passage of time, or technological advancement. So we are saying that a fixed tangible asset's value can fall because you are always using it and parts will be wearing and tearing off, or sometimes passage of time, or maybe changes in technology. So for example, if I have a vehicle, as I continue to use the vehicle, some of the parts will be wearing off due to rusting, or due to rust. Okay. And, as I drive, the tires or the car tires, because of friction, would also be wearing off. Okay. Even one of the common examples is the shoes that we wear. You always see that the soles of the shoes, right, are always wearing off. That is depreciation, but it should be of a fixed, tangible asset. An asset you can see, feel, and touch, like building, vehicle, fixtures and fittings, plant and machines. When their values fall, we term them as depreciation. In terms of technology, you would all acknowledge that we don't have certain types of assets in the system again because of technology, right? Gradually, tablets and laptops are replacing the desktops, the desktop that we used to have. This cathode ray tube televisions that we used to have, what we used to call Etikopo TVs. I don't know if some of you came to meet some in the system. Now we have the flat screen smart HD TVs, right? Another one is this typewriter. Those days, I'm sure your parents would appreciate the use of typewriter. Now it has been taken over by laptops, computer, etc. So technology can also make the value of an asset fall. If you have a typewriter now, I'm not sure it is going to be of value because it's not going to be useful. So that's depreciation. So businesses always would have to check their fixed assets to determine any loss in value or fall in value, and that's depreciation. And this is treated as an expense in the profit and loss account, right? Because it is deemed to be that part of the assets the business is using to generate income or money. So when we talk of provision, it is a charge against the profit, okay, for the use of the tangible assets, which results to wear and tear, etc. of the asset. So because the business is continuously using the asset, it has to account for the parts that is wearing off, and they do this by making this provision. And what they specifically do is to charge an amount against the profit or subtract an amount or that amount of depreciation from the profit. Now, provision for depreciation is normally estimated using some methods. Under the final account, we'll look at two of these methods. We have several methods, but under the final account, we'll look at these two. The first one is the straight line method. Straight line method. The second one is the reducing balance method. So for now, just appreciate what these two methods mean. And as we go on and we begin solving illustration, you appreciate them better. So straight line method here means that the depreciation is determined by multiplying a fixed rate, and again note this, a fixed rate on the cost of the asset. So let me do an example here for you to appreciate. Under the straight line method, the point we are making, or the point I'm making, is that a certain percentage, and that percentage is fixed. When we say it's fixed, it means that that is the percentage we are going to use every year to depreciate that asset. So for example, if we bought a building for 12,000 Ghana cedis, so that becomes the cost of that building. If we are depreciating this using the straight line method, then it means that a certain fixed rate, let's assume 20%, would be multiplied by this cost. And 12,000 multiplied by 20%, that will give us 2,400. So it means that 2,400 would be charged as provision for depreciation on that building. So under the straight line method, you would have to apply a fixed rate, and the rate is given to you always in the question, so you don't have to worry about it. There's a way to find the rate, but for your level and in your studies, the rate is always going to be given to you. So you just multiply it by the cost of the asset, and that is what you have to note, the cost of the asset. It is different when you come to the reducing balance. Here, you don't apply the rate on the cost of the asset, you apply it on what we call net book value. And I believe you appreciate this term or this concept from our discussion of the balance sheet, the net book value. So you remember the net book value is the cost minus any previous depreciation. The cost minus any previous depreciation. So you can agree with me that in the first year, always the reducing balance and the straight line method will give you the same figure. But as you move to the second year, straight line method will always have a fixed depreciation. So if you had 2,400 in this example, second year it will be 2,400. But for reducing balance, in the second year, you'd have to subtract the depreciation for the first year from the cost. So let me use this example. When we calculated, we had for the first year, right, 2,400. So in the second year, it will now be 12,000 minus 2,400 multiplied by 20%. So you have to subtract the previous depreciation from. So that will be in the second year. In the third year, it will be the cost minus the depreciation of the second year minus the depreciation of what? The first year, before you apply the rate. So the reducing balance method suggests that you always subtract the previous accumulated depreciation before you apply the rate. So that's the difference. Straight line is on cost, so every year on cost, which makes the depreciation fixed. It doesn't change. But for the reducing balance, as you continue from year to year, you would have to subtract the previous year's depreciation. So you are going to have different figures for each year. Okay. So these are the methods for calculating depreciation. When we take scenarios, you appreciate better. So in terms of the accounting treatment in the profit and loss account, as I've hinted, you would charge it as an expense. So under your operating expenses, you will see provision for depreciation on your asset. So if it's a building, provision for depreciation on building. However, let me be quick to add this and note it that in accounting, okay, in accounting, land is the only fixed tangible asset that is not depreciated. So in accounting, we don't depreciate land. The reason being that land appreciates and it doesn't depreciate. When you go to the economics, they depreciate land because they have their own assumptions and reasons. But in accounting, land is not depreciated. So take note of that. Now, in the balance sheets, whatever depreciation you've accumulated so far, right, you deduct it from the cost of the asset. So go back to the format of the balance sheet, you appreciate the accumulated depreciation there, which is deducted from the cost of the asset to get the net book value. Okay. Now let's talk about bad debt and provision for bad debt. So bad debt is different from provision for bad debt, right? Bad debt sometimes can be referred to as doubtful debt. So what is it? It refers to an amount owed to a business by its customers that cannot or may not be settled. So it is bad debt if it cannot be settled or it cannot be redeemed or cannot be collected. So if your friend owes you 10 cedis and due to certain condition you cannot collect the 10 cedis, then it means that that 10 cedis debt is bad to you. It is doubtful when you have reasons to believe that it may not be settled. So though there is a thin difference between them, thin line difference, they are used interchangeably. Okay. But bad debt means that you are not able to collect the debt. The debt is irredeemable or cannot be recovered. But doubtful means there are reasons for you to suggest it may not be settled. So a doubtful debt is a debt that may not be settled. But a bad debt is a debt that cannot be settled. And there are reasons for that. For example, if, unfortunately, I may have to use this example. If your friend owes you 100,000 Ghana cedis and by an accident, he's out of this world. But let me use the plain term, he dies or she dies. The question is, I'm not sure you can be able to ask his or her ghost to pay you your debt. So anytime a debtor dies or passes on, the debt automatically becomes bad unless there was an arrangement for someone to take over the debt on his or her demands. So death is one of the reasons why a debt may be deemed bad. Another one is when the person goes mad or insane. If your debtor is mad or goes insane, well, in my life, I've not seen anybody chasing a mad person to redeem his or her debt with a person. So insanity is also one of them. And number 3, if the debt is insignificant, and please, I hope you are noting this point. So 1, I said, death is one of them. The person can die, the debtor can die. 2, when the debtor goes insane or insanity. 3, if the debt is insignificant or immaterial. Okay, imagine your friend owing you 1 pesewa. Technically, what is 1 pesewa? It's insignificant. And a debt is categorized as insignificant if the cost of recovering the debt outweighs even the amount or the value of the debt. So, for example, your friend is in Kaswa, you are in Cape Coast, your friend owes you 1 pesewa. If you are going to collect this 1 pesewa, you would have to take a vehicle. So, transportation cost, that will cost you like averagely 50, 60 cedis to get to Kaswa from Cape Coast. So look at it. You are going to spend 60 cedis to go and collect 1 pesewa. It doesn't make sense. So the debt is insignificant. So you would have to declare it as bad debt. And the last one is when the debtor is declared bankrupt by a legal statute. So sometimes if by law your debtor is declared bankrupt, and if a person is declared bankrupt, what it means is that the person has gotten to a point where his resources cannot settle his debt. Okay, so most of the times, the assets of the person or the assets of the person are sold. to generate money to settle some of the liabilities. Okay. So if the person or the debtor is declared bankrupt by a legal statute, so by law, it's not just that you just wake up and say I'm bankrupt and people should forgive you your debt. No. In the profit and loss account, doubtful debt or bad debt is an expense. So we add it to the expenses under your operating expenses. In the balance sheet, you would subtract it from your debtor's balance. So note these two. In the profit and loss account, it's part of your operating expenses. In the balance sheet, it is deducted from the debtor's balance. Now, the last concept will be the provision for bad debt. The last concept is the provision for bad debt. So the issue is if you're able to estimate or determine that your debtors, by virtue of some reason, cannot pay or settle, then you have to make a provision. The provision is just to cushion you in the event that the debtors are not able to pay, right? And this is backed by one of the concepts in accounting called prudence concept, that a business should always be ready, to cushion itself from future possible expenses or losses. So it's always the case that you anticipate for expenses or losses and you make provision for them, right? Okay. Even as a student, you know that definitely when you come to school, you would have to incur some expenses for chop money, right? So you have to make provision for your chop money. So provisions are estimates or charges against profits, okay, for you to cushion yourself. In the case of this concept, it is a charge against profit in order to allow for bad or doubtful debt. So it's more or less like setting aside some of our profit, okay, to cancel a possible debt that cannot be collected. So if we are doing business and this year we've made a profit of say 5,000 Ghana cedis, but people are owing us, and per review we can tell that some of our debtors may not be able to pay because of the reasons I've given you, right? Then it's prudent that we set part of that profit we have made this year against those future possible bad debts. Okay. So that if any of your debtors unfortunately dies, at least you have some of your profit to, pushing the business. So the accounting treatment, though, depends because, like I'm saying, you can make a provision this year that maybe you heard that one of your debtors is sick, seriously sick. So you assume that the person may die and will not be able to pay his debt or her debt. So let's assume that this person was owing you 56, right? And because you heard of his illness, you decided, okay, the way they are saying is critical, he or she will die. So let me set aside 50 cedis out of my profit so that if it happens that he passes on, I'll use the 50 cedis to at least settle it. Okay. It can happen that miraculously this person didn't die and will come to settle his debt. So because this person didn't die and is now coming to pay his debt, the provision you made earlier would not be needed. So at that point, you would have to decrease that provision because the reason for which you made that provision is no more relevant. The person didn't die. The person has come to settle. So in a way, your provision is not needed. So you have to decrease it. Or another scenario is you have two debtors. One owes you 20 cedis. The other owes you 30 cedis. And both of them are not feeling well. They are ill, seriously. Or let me say, they are going insane, right? Now, you made a provision for 50 cedis to cover these debts if they are not able to pay. Then it happens that one of them recovered and then came to pay. So he came to pay the 30 cedis. So any prudent accountant will realize that, okay, I made provision for this 50, but 30 has come to settle. So I don't need to still continue to provide 50. I have to decrease my provision from 50 to what? 20. So the point I'm trying to make is that there are times where you do an assessment and you come out that, or you determine that you need to decrease the provision. Let me give you a practical example. If you come to school and you make a provision that when you vacate, you take a Ford bus or an STC bus. So you made a provision for your transport, right? So your TNT. Let's say you made a provision of TNT for 120 Ghana cedis. Then on the D-day of vacation, you went to the station and they are telling you, oh, the transport is 100 cedis. So what does it mean? It means that you made an excessive provision, or the provision you made was higher. So when you compare, it means that technically you have to decrease your provision from 120 to 100. Now, if there is a case where you can get a decrease, then we can also say that there are scenarios where you get an increase. So in this scenario, for example, you budgeted for 120 for your transport. You go to the bus terminal and they are telling you that the transport is 180. So then you see that your provision is not enough to cover for your transport. So you'll have to increase the provision. So I'm giving you two scenarios here, where there is an increase in provision or there is a decrease. Now, if there is an increase in provision, it is treated as an expense in the profit and loss account. But if it is a decrease, it is treated as a gain. So it is added to the gross profit as part of the other income. And this is very simple. Remember, from the beginning, I indicated that you are making this provision from your profit, right? So let's say you have profit of 100 cedis. You have a profit of 100 cedis, right? And then you make a provision of 20 cedis out of it. So it means that this 20 cedis was charged as an expense. So after making this provision, your profit will now come back to what? 80 cedis. If it turns out that this provision 20 cedis you made is very small, you need to increase it to, let's say, 40. So if you need to increase it to 40, then it means that you need extra 20 from your profit. So you come back to your profit and what? Subtract again. That's why we say for increase, you add it as expense because it has to be subtracted from the profit. The reverse is true in the sense that if after making your provision of 20, it turns out that the actual expenditure was 10 cedis, okay? So you made a provision of 20, your profit is left at what? 80. Then the actual bad debt or the actual expense that you made the provision for became 10 cedis. Okay, so the actual is now 10 cedis, which means your provision was more than the actual. So here you have to decrease your provision. And if you check the decrease, it is 10 cedis. So this 10 cedis decrease, what happens? It comes back to add to the profit. Because you took it out of the profit, it turns out that it's not needed. So for decrease in provision, you add it back to the gross profit. And that's what it means when you see it's credited to the profit and loss account or is added to the gross profit. So under your other income, when you are adding discount received, commission received, investment received, You also add the decrease in provision. But if it's an increase, that one you add it under your operating expenses. In the balance sheet, note the new provision, and I want students to always remember this, the new provision is deducted from the debtors balance. So you subtract it from the debtors balance. What are you subtracting? The new provision, the new provision, the new provision. Remember, we did an analysis to see whether there is an increase or a decrease. So there is always the case that you have a previous and a new, old provision and new. In this our discussion, the 20 cedis is the old and the 10 is the new, right? Okay, and the new actually comes about when you have seen the actual expenses, or sometimes when conditions have changed and that what you earlier provided for has to be decreased. Okay, so I think we'll end here, but today we have been able to look at the remaining adjustment. We started from when the owner withdraws goods, or what we call drawings, but we were able to tell that the drawings may be in the form of goods, it may be in the form of cash, or from withdrawal from the bank, or it may be an expense of the owner which has been added to the business expenses, right? Okay, so we'll end here. God willing, our next or our third lesson, we'll start solving examples or illustrations for you to appreciate this better. And then maybe I'll speak about the interest on loan. So stay safe. I'll see you in our third lesson. Bye-bye.